Hey there, and welcome back to the Deep Dive. Today we're plunging into something that honestly sounds a bit like science fiction, but it's actually happening right now, and reshaping how we think about owning things, about investing. It's real-world asset tokenization, or RWA tokenization. Just imagine like owning a tiny piece of a skyscraper downtown, or maybe a slice of a famous painting, or even, I don't know, a barrel of oil. And having it all managed transparently on a digital ledger, that's the core idea we're exploring today. And it's not just for the big banks anymore.
It really is a paradigm shift, a huge one. We're talking about taking tangible assets, things you can actually touch, like buildings, art, commodities, and turning their ownership into digital tokens on a blockchain. Our deep dive today, looking at these sources, will hopefully clarify not just the what, but really the why this matters and how it's poised to transform, global finance and maybe even more.
Exactly. And we've got some really fascinating sources here. They paint quite a picture, from the sort of nitty-gritty blockchain tech details right up to the big questions regulators are wrestling with. So the big question is, what does this all mean for you? Let's unpack it.
What is RWA tokenization and why should you care?
Okay, first things first. For anyone who's maybe hearing this stream for the first time, what exactly is RWA tokenization, like at its heart, and why is it suddenly such a big deal?
Right. So at its core, RWA tokenization is simply the process of creating a digital representation of ownership for a real-world asset on a blockchain. Think of it like digitizing the deed to your house or maybe a share certificate for a company you invested in. It's that proof of ownership, but in token form. Now, why the buzz now? Well, the numbers are pretty compelling. Your sources are showing explosive growth projections. Some estimates are throwing around figures like, $24 trillion by 2027, even $16 trillion by 2030 in some forecast. I mean, these aren't just incremental changes. That's a massive potential shift in how we handle value.
Wow, okay. Those numbers are genuinely staggering. But what's driving that? What are the actual, real-world benefits making people think it'll grow that fast? What problems does it actually solve for someone?
Well, what's really interesting is that it tackles problems on multiple levels. Traditionally, managing assets, especially complex ones like real estate or private equity, it's slow. It's often paper-based, prone to errors, involves tons of intermediaries, lawyers, brokers, RWA tokenization, streamlines, all that. Things like funding deals, executing trades, settling transactions that can be automated using smart contracts on the blockchain. This cuts down massively on manual work, potential errors, and the time it takes. Think weeks or months, potentially shrinking down to days or even minutes for settlement. That's a huge efficiency gain.
Okay, so efficiency is definitely a big driver. That makes total sense. But you mentioned earlier owning just a fraction of a skyscraper. That accessibility angle sounds like a game changer too.
Absolutely. And for many, this is the most exciting part. Tokenization enables fractional ownership in a way that just wasn't practical before. So instead of needing, say, millions to buy into a commercial real estate project, you could potentially invest maybe $1,000, maybe even less, by buying a token representing a small share of that property. This blows the doors open for accessibility. It brings potentially more liquidity to traditionally illiquid assets because tokens can be traded more easily. And it lets you, the investor, diversify across asset types you might never have had access to before. More dynamic, more inclusive markets.
The foundational technology blockchains and their engines.
Okay, so incredible benefits, efficiency, accessibility, liquidity. But it all kind of hinges on the tech underneath, right? The blockchain itself. How does blockchain actually deliver on that promise of unmatched security, transparency, and efficiency that our sources talk about?
Right, that's the crucial question. What makes a blockchain suitable, robust enough for something as critical as representing ownership of real-world assets? Well, the foundation is security. Blockchains provide an immutable transaction history. Every transaction is cryptographically linked to the previous one, recorded across many computers. It's incredibly hard to cheat or tamper with. That builds trust. Then you have smart contracts. These are like self-executing agreements written directly into code on the blockchain. They automate processes. Think dividend payouts for a tokenized stock, or automatically transferring ownership tokens when a sale condition is met. This cuts out intermediaries, reduces administrative costs, and minimizes human error.
Okay, now this is where it gets really interesting for me. The sources talk about different consensus protocols, like the engine running the blockchain. Can you sort of break down the main types, especially this Snow family mentioned for Avalanche? Sounds intriguing.
Sure. So historically, we've seen a couple of main approaches. There's classical consensus, which is fast but often less decentralized, needing lots of communication between known participants.
Hmm.
And then there's Nakamoto consensus, which is what Bitcoin uses. That's based on proof of work, or POW, basically a computing power race, to validate transactions. Very secure, but notoriously energy intensive. Then you have this newer generation, the Snow family, which powers Avalanche. It includes protocols like Avalanche, Snowman, and Frosty. These are quite innovative. They're kind of a hybrid, taking good ideas from both classical and Nakamoto, but using a lightweight network sampling method. Instead of everyone shouting at everyone, or a massive energy burn, nodes just randomly ask a few other nodes their opinion, and through repeating this quickly, the whole network reaches agreement very fast. This means low latency, high throughput. It can handle thousands of transactions per second and scale to millions of participants. And critically, no POW mining. So they're much greener, more energy efficient, and quiescent, meaning they don't waste energy when idle.
Greener, faster, scales better. That does sound like a pretty significant leap forward, especially if you're thinking about tokenizing lots and lots of assets. What about Ethereum? It's sort of the giant in the room for smart contracts. How has its engine changed? I saw mentions of the Paris hard fork in Shanghai. What was that all about?
Right, Ethereum is the pioneer, no doubt. It really kickstarted the whole smart contract revolution, which is fundamental to RWA tokenization. Initially, Ethereum also used that energy-hungry proof of work, but the Paris hard fork, which most people know as the merge, was a massive fundamental shift. It transitioned Ethereum's consensus mechanism from proof of work to proof of stake, or PEPO. This was primarily driven by the need for greater energy efficiency. We're talking like a 99% reduction in energy use and better scalability. The beacon chain was introduced earlier to manage this new POS system, and the Shanghai update came later, allowing people who had staked their Ether tokens to help secure the network to finally withdraw them. It was a key step in maturing the POS system. POS works by having participants lock up or stake their own tokens as collateral. This incentivizes them to act honestly to protect their stake, achieving security without the huge energy cost of PEPO mining.
Okay, and Avalanche uses proof of stake too, right? Our sources mentioned it has an egalitarian distribution of minting, and it doesn't like punish stakers by slashing their tokens if there's a software bug. How does that help for RWAs?
That's correct. Avalanche also uses proof of stake, and its implementation has some specific design choices highlighted as green, accessible, and open to all. Quote, the economic incentives are designed to strongly encourage nodes to act correctly and secure the network. But a key philosophy is predictability. Staked tokens aren't at risk of being slashed, meaning forfeited due to unintentional software bugs or hardware failures. This is a big deal for institutions or individuals wanting predictability. Also, rewards for staking are designed to be distributed equitably based just on the amount staked and uptime, aiming to prevent that rich getting richer feedback loop you can sometimes see where large holders gain disproportionate influence. Even the minimum amount required to stake is quite low and adjustable through governance, encouraging broader participation without necessarily needing to delegate your stake to a big pool operator. These features definitely enhance its appeal for, say, regulated financial institutions looking at RWAs.
The top contenders navigating the blockchain choices for RWAs.
Okay, so different engines, different strengths. It makes sense then that certain blockchain platforms would be, well, better suited for tokenizing specific kinds of assets. Our sources listed the top 10 blockchain choices. Could you give us maybe a highlights reel? Who are the key players and what makes them stand out specifically for RWAs?
Definitely. And it really is about finding the right tool for the specific job. There's no single best blockchain for every RWA use case. So first, you absolutely have to mention Ethereum. It's the pioneer, the OG of smart contracts since 2015. It really laid the groundwork. Its ERC20 standard is basically the global template for fungible tokens things, where each unit is interchangeable, like shares or bonds. And ERC721 is the standard for non-fungible tokens, or NFTs, representing unique assets like art or specific real estate parcels. The key thing with Ethereum isn't just its history, it's its huge network effect. Massive developer community, most battle-tested security, deep liquidity. That's crucial for high-value RWAs. The downside. Historically, high and unpredictable transaction fees, gas fees, and lower transaction speeds, though upgrades are addressing this.
Right, those gas fees have been a major talking point, so that naturally leads to solutions trying to fix that.
Exactly. And that brings us to platforms like Polygon. Polygon is probably the best-known Layer 2 scaling solution built on top of Ethereum, or alongside it. It's designed specifically to tackle Ethereum's high fees and slow speeds. It offers significantly lower gas fees and much faster transaction processing, like thousands of transactions per second compared to Ethereum's maybe 30 or so historically. Crucially, it's compatible with Ethereum's tools and ecosystem, making it easy for projects to use. It's become very popular for things needing higher volume, like maybe tokenized real estate fractions or certain commodities. The trade-off sometimes mentioned is that its validator set, the computers confirming transactions, can be seen as a bit more centralized than Ethereum's mainnet.
Okay, so Polygon helps Ethereum scale. Where does Avalanche fit into this picture then, with its unique features?
So Avalanche, as we touched on, is built for speed and scalability right from its core, but its real differentiator is customizability. It is this feature called subnets, subnetworks. These allow businesses, or even whole industries, to launch their own blockchains tailored to their specific needs. They can set their own rules, choose their own validators, maybe require specific KYC and compliance checks at the chain level, even use their own token for gas fees. This is huge for regulated industries looking at tokenization. Combine that with its high speed, thousands of transactions per second, and near instant finality, it's very appealing for institutional RWA use cases needing both performance and control. Its ecosystem is younger than Ethereum's, but growing fast.
That subnet idea.
Yeah.
Yeah, I can see how that would be really attractive for big companies needing specific compliance. What about just pure raw speed? Any standouts there?
For sheer speed, Solana often gets the spotlight. It's frequently described as lightning fast. It uses a unique consensus mechanism combining proof of stake with something called proof of history, which helps order transactions incredibly quickly. This allows it to handle, theoretically, over 65,000 transactions per second with very low costs. This makes it really well suited for applications needing real-time settlement, high-frequency trading of tokenized stocks or bonds, maybe micropayments, things where speed is absolutely paramount. Its main challenge historically has been occasional network stability issues during high load, though it continues to improve.
That's a good range of options already. Any others worth a quick mention that bring something unique to the table for RWAs?
Sure, there are others carving out niches. Binance Smart Chain, BSC, is known for low fees and speed, often appealing to retail users, those generally considered more centralized. Tezos puts a strong emphasis on being eco-friendly and uses something called formal verification for its smart contracts. That means the code is mathematically proven to work as intended, which is really valuable for high-stakes assets like, say, intellectual property or complex financial instruments where bugs could be disastrous. You also see platforms like Hedera Hashgraph using a different structure called a DAG for enterprise-grade performance. Stellar focuses on cross-border payments. XDC Network targets trade finance. And Cardano is known for its research-driven, peer-reviewed approach, focusing heavily on security and sustainability, often appealing to institutions. Each has its own strengths and trade-offs depending on the specific RWA needs.
The regulatory frontier ensuring trust and stability.
Okay, so the tech is moving incredibly fast. The potential seems huge. But, whenever you have this kind of disruption, especially in finance, the regulators can't be far behind. One of our sources was a consultation paper from IFSCA, the International Financial Services Centers Authority. What are regulators like them trying to figure out as RWA tokenization really starts to take off?
That's a critical piece of the puzzle. How do you foster innovation while ensuring market stability and protecting investors in this completely new digital environment? Organizations like IFSCA clearly see the transformative potential. They're not trying to stifle it, but they're focused on creating a comprehensive and consistent regulatory framework. They've even set up specific bodies, like an expert committee on asset tokenization, to study the implications and recommend rules for a healthy digital asset ecosystem.
That sounds like a massive job. What are some of the really thorny issues, the specific concerns they're trying to nail down right now?
Well, first and foremost is establishing legal and regulatory certainty. If you tokenize a building in London and someone in Singapore buys that token, who legally owns what? How does that digital ownership translate back cleanly to the physical asset, especially across borders? That's fundamental. Then there's the need for clear redemption and exit mechanisms. If I hold a token representing gold, how do I actually get the gold or its cash equivalent reliably? Investors need clear paths to exit their positions. Regulators are also looking closely at how token ownership itself is structured. Is it bearer form, meaning whoever holds the private key to the token owns the asset, like digital cash? Or is it registered form, where ownership is tracked in a ledger maintained by the issuer, more like traditional stocks? Which model fits which asset type, and what are the legal implications? These are big questions. And IFSCA, for example, explicitly states that issuing and custodying digital tokens should be considered regulated activities. That means platforms offering these services will likely need licenses and have to comply with financial regulations. They also acknowledge that this new DLT-based market infrastructure, especially using smart contracts, might need differentiated treatment. You can't just slap old regulations onto fundamentally new technology. You need rules that understand its unique characteristics and, importantly, its unique risks.
Right, new tech, new risks. That makes sense. What kind of risks are specific to this tokenization world that regulators are worried about? Can you give some examples?
Indeed. The sources highlight several key areas. You have governance risks, especially with more decentralized platforms. Who's in charge? How are decisions made? How are upgrades managed? Then there are significant technology risks. Because DLT and smart contracts are relatively new, there's always the possibility of discovering unforeseen limitations or vulnerabilities after the market is already heavily reliant on them. Think about a bug in a smart contract controlling millions in assets. The consequences could be severe. Of course, cyber risks are huge. Protecting these digital tokens, the wallets holding them, and the platforms trading them from hackers is paramount. And a perennial concern for regulators is money laundering and terrorist financing, MLTF risk. Ensuring that the speed and potential anonymity of some blockchain transactions aren't exploited for illicit purposes is a major focus. Finally, and this is crucial, there are investor protection concerns. How do you ensure investors understand what they're buying? These aren't traditional stocks or bonds. They need clear disclosures about the risks, the underlying asset, the technology. Education is key because these markets can behave very differently.
Wow, yeah. That's a lot for regulators to juggle.
Yeah.
Are there any, major roadblocks that could genuinely slow down this whole RWA tokenization wave, despite all the hype and potential?
Absolutely. Progress isn't guaranteed to be smooth. The OECD, for example, points out a few potential hurdles. One is the lack of liquidity in these new tokenized markets. If you tokenize an asset but there aren't enough buyers and sellers, you don't get the promised benefits of easier trading. Liquidity needs to build over time. Another is the absence of a fully mature ecosystem. We need better connections between different blockchains, between tokenization platforms and traditional financial systems, standardized processes, basically. The plumbing needs to be fully built out. And maybe most fundamentally, there's the need to demonstrate clear, measurable, large-scale benefits. Businesses and investors need to see tangible advantages that outweigh the costs and complexities of switching from traditional methods. Building that trust, proving the value proposition, and developing the infrastructure, it's definitely an ongoing process.
Well, that really was a deep dive, wasn't it? We've covered a huge amount of ground, from figuring out what RWA tokenization even is, to why it's exploding now, the different blockchain engines like Avalanche and Ethereum powering it, and the really critical regulatory landscape that's still taking shape.
It's definitely clear RWA tokenization isn't just some niche tech trend. It feels more like a fundamental financial evolution. It promises to make investing more accessible, make markets more efficient, maybe unlock liquidity in assets that have been stuck for centuries.
Yeah.
And the choice of blockchain matters, whether it's Ethereum's established network, Polygon's scaling, Avalanche's customizability for institutions, or Solana's speed. Each offers a different path. And regulators like IFSCA are, working hard to build guardrails that allow innovation but also protect people and keep the system stable.
Okay, so let's try and boil it down one last time. What does this mean for you listening right now? Well, you're now hopefully much better informed about a market that some people think could be worth trillions, a shift that might fundamentally change how you access and own different kinds of assets around the world.
And maybe a final thought to leave you with. If we can take any physical asset, break it down into countless digital tokens, and trade those tokens instantly across the globe, does the core idea of ownership stay tied purely to the physical thing itself? Or is it actually migrating, fundamentally shifting towards the secure, verifiable code that represents it on that blockchain? Think about what that means for value, for access, for everything. It's a big question to ponder.
Definitely powerful stuff to think about. Thank you so much for joining us on this deep dive into real-world asset tokenization. Until next time, keep learning, keep asking questions, and stay well informed.